Buy your gold and silver from SD Bullion. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. Hey everybody, Smart Silver Stacker here. Welcome to the first live stream of 2024. Now, you're going to have to bear with me here. I've been on a bit of a hiatus over the holidays. I'm back now, but we've got a lot to delve into in today's video, not the least of which is this headline: Saudi Arabia officially joins BRICS bloc, State TV. Now, this is not a surprise. I mean, we knew following the August meeting in August 2023 of the BRICS that Saudi Arabia was going to be invited along with these other nations to join. Saudi Arabia now joining BRICS along with the United Arab Emirates, Egypt, Iran, and Ethiopia. The only country not accepting the invite extended last year was Argentina. But this is so important, and this really sets the tone, I think, for 2024, because this move has the potential to turn the entire global power structure, the entire global economy on its head. Because one of the main factors that has driven U.S. policy in the Middle East, and the Middle East, a critical region because of its oil production and exporting capacity, has been the petrodollar system. And now, with Saudi Arabia joining BRICS, that system, I know we've been talking about this for a while, it's been getting chipped away at. I think it is really on its last legs now. According to this report from Reuters, Prince Faisal bin Farhan has said the BRICS group was a beneficial and important channel to strengthen economic cooperation. So you got to think about what economic cooperation within the BRICS nations means. I mean, a lot of their focus has been on de-dollarization, on shifting away from the U.S. dollar to settling international payments in local currencies, the yuan, the ruble, the other BRICS currencies. And very importantly here, China has been petitioning these Middle Eastern nations to sell their fossil fuel exports, the oil and natural gas, via the Shanghai Petroleum Exchange denominated in yuan. And I think that 2024 might be the year that we see that adopted in a big scale. And, this is just one of the stories we're going to cover in today's live stream. Again, a lot is happening in 2024. The year is just 4 days in, and already so much is happening. So bear with me here. We're going to try to cover as much as we can. But, the petrodollar system set up by Henry Kissinger and Nixon along with the Saudis. It was the agreement by which the Saudis would only sell their oil in dollars. And again, them joining the BRICS, this is going to turn all of this on its head. And I don't think it's a coincidence that this is playing out at the same time that the Middle East is on the verge of a major regional war. Let's talk about that a little bit and get into some of the updates in the Middle East so far in 2024. We have blasts via a terrorist attack in Iran, killing 100 people, nearly 100 people. I mean, the reports are kind of mixed. I've seen different numbers, but a major attack at an event that was commemorating the death of General Soleimani, who, if you remember, was assassinated while the previous president, Trump, was in office. And I don't know who's responsible for this. The U.S. and Israel have denied that it was them. I mean, there's a lot of things you can kind of think about who would benefit from this, who's potentially behind this. But I think one of the major things that we can take away from this is that one of the best ways to condition a population to prepare for war and the hardships that entails is attacks of this nature. So certainly I'm sure the Iranian people now more on board for a war than they were previously, and this is just a sign that the Middle East is devolving into what is likely going to be a larger regional war. That, of course, will have major impacts on commodity prices, on petroleum, you name it. The whole global power structure is about to be turned on its head, and we're going to talk about that as we get through this live stream. Of course, the U.S. economy also on the verge of some major shifts, not the least of which will be the abandonment of the petrodollar system as this conflict comes to fruition, as it breaks out. Remember, Iran and Saudi Arabia both joining the BRICS nations, two historically adversarial nations, the West kind of traditionally playing them off against each other. Well, it looks like that's probably going to come to an end, if you ask me. Of course, there's a lot of moving parts here, so it's hard to say exactly what will happen. And do me a favor, by the way, this is a live stream. It helps a lot if you smash that like button to get this information out into the algorithm, so I greatly appreciate any of you who do that. Let's see here. Also, the day prior to that terror attack in Iran, there was notably an Israeli drone strike which killed a Hamas high-level leader. Now, that's not so much important, but it's important to note where this took place. This was in Beirut, so in Lebanon. And this is another one of these aspects of the Middle East evolving into a broader regional war that we need to keep an eye on. The potential for a conflict between Lebanon and Israel, or perhaps Lebanese Hezbollah, the Iranian-backed militia in Lebanon and Israel. And, it wouldn't be the first time they've gone to war, but this time I think it could be a bit different. First of all, the IDF already somewhat bogged down in Gaza, and they're going to be fighting a conflict on a lot of fronts, potentially. And so it almost ensures, if this happens, that the U.S. will be drawn in some way, shape, or form into this brewing conflict. Now, let's take a look at the price of crude oil, because this is one of those things which will be affected dramatically by a broader regional conflict in the Middle East, and which will have a massive impact on the U.S. economy, the global economy. Will even have far-reaching effects as for terms of, what the Federal Reserve does next, which is driving these markets. So you can see how this is all interrelated. The price of crude oil kind of spiking up on some of this volatility in the Middle East surrounding those terror attacks and these drone strikes. But also, there's kind of two forces at play here. One is the potential for a conflict impacting supply chains and impacting petroleum production. Also, you have a weakening global economy, and the U.S. also turning out record amounts of crude oil. Now, again, this Saudi Arabia joining BRICS thing, it's not like it's a one-sided move. I mean, the U.S. has some cards to play, too. We've got a bunch of aircraft carriers, a huge military, for example. We also have now become the world's largest producer of petroleum. So, we're doing what we can to try to pursue our agenda. The Saudis and the BRICS and the Global South, as some people refer to them, kind of pursuing their own. But crude oil is mixed here. I do think that we are going to see much higher crude oil prices, though, despite whatever the current administration wants to do to try to keep prices low. Of course, this is going to be an election year now, so 2024 is going to be a little interesting, I think. But the forces that want to keep crude oil lower, I think, are fighting an uphill battle here, because this conflict in the Middle East it appears to constantly be on the verge of expanding. Now, let's talk a little bit more about markets. We've got the CME FedWatch tool here, which is sort of a assessment of what markets anticipate the Federal Reserve is going to do next in terms of interest rate policy. And that's very important for gold, silver, markets in general, because basically all of the price action in this manipulated economy that we have is driven by what the Federal Reserve will do next. And this is the March rate, the March FOMC meeting that we have selected here in the CME FedWatch tool. And one thing you'll notice, 62.1% chance of a 25 basis point rate cut, 4.3% chance of a 50 basis point rate cuts. These numbers are coming down. Markets appear to be less optimistic about Fed policy moving forward. Now, there's a lot of things driving this, and this is very important for markets. I think this is in part why we saw kind of a large broad-based sell-off across markets yesterday, across gold and silver as well. But what is driving this pessimism? Well, part of it was some notes from the last FOMC meeting that were released, but also I think that there is a geopolitical aspect of this as well. Here's a story from a couple days ago about how the U.S. has now sunk some Houthi boats in the Red Sea. There was an attack on one of these container ships. The U.S. helicopters responded to a distress call. They sunk 3 Houthi rebel boats. One of them managed to escape. And a reaction to this was Maersk, the world's largest shipping company, had once again halted Red Sea transit. So they had halted that earlier in December. They had tried to reinstate shipping through the Red Sea. Turns out that wasn't such a great idea. One of their ships got hit by a missile. There was this skirmish between U.S. forces and the Houthis. So now, once again, the world's largest shipping company has halted these voyages through the Red Sea. This will put upward pressure on costs of goods across the board. Anything that has to get shipped, which is, a lot of things in this globalized economy, less and less globalized, but still, we rely on these shipping lanes. And so this has the potential to cause inflation to rear its head once again. And that, I believe, may have an impact on what the Federal Reserve does next. Now, I mean, I think that they're destined to cut, they're destined to print in 2024. It's the only option they have to prevent the whole thing from falling apart. But to the extent that inflation goes higher, that is going to put a bit of a damper on the money printing party because, you know, if inflation stops coming down, I mean, inflation has never come down, by the way. It's just the rate at which it's been increasing has been declining, this whole disinflation thing. But to the extent the disinflation stops, it's going to make it more difficult for the Fed to begin printing. Now, they're going to figure out some way to do it, but nonetheless, this is going to have a big impact. And also, you know, the shutting down of these trade routes, it's going to have an impact on inflation. Fed printing will too. So we could see very high inflation for the rest of 2024. And that is something that I think is more likely than not. So yesterday we had another attack. Houthi militants claim to have attacked another merchant ship in the Red Sea, serving as a reminder of the threat they pose to a vital trade artery. This is from Bloomberg. The Houthis' armed forces spokesman said in a televised speech that a vessel called the CMA-CGM Tage was attacked after ignoring warnings. The French shipping giant who owns this ship said the vessel did not suffer any incident. Houthis are saying they attacked it. The United Kingdom Maritime Trade Operations, a British naval detachment, said on its website that a vessel came under attack around the time the CMA-CGM Tage would have been passing through. So the point is the attacks continue. And this is very important because this means that we could be, again, on the verge of a major regional conflict, one that continues to spread. Just look at the statement that was issued by the governments of the U.S., Australia, Bahrain, Belgium, Canada, Denmark, Germany, Italy, Japan, Netherlands, New Zealand, Singapore, and the United Kingdom. And basically, this is the U.S. leading the charge. This is from the whitehouse.gov, a warning to the Houthis that they need to stop these attacks. And if they don't, we could be looking at U.S. or coalition military strikes in Yemen. The report here, the warning, ongoing Houthi attacks in the Red Sea are illegal, unacceptable, and profoundly destabilizing. There's no lawful justification for intentionally targeting civilian ships and naval vessels. You got the whole statement up here on the screen if you want to read it. Nearly 15% of global seaborne trade passes through the Red Sea, including 8% of global grain, 12% of seaborne traded oil, and 8% of the world's liquefied natural gas trade. So, you know, the important stuff, the food, the energy, the things that if people don't get them, they tend to get a little upset, you know, especially marginalized portions of the population. When you can't afford food, you can't afford energy, can lead to global unrest. This is another thing that we can look out for more of around the world in 2024. And then finally, probably the biggest takeaway from this warning is let our message now be clear. We call for the immediate end of these illegal attacks and release of unlawfully detained vessels and crews. The Houthis will bear the responsibility of the consequences should they continue to threaten lives, the global economy, the free flow of commerce in the region's critical waterways. So expect attacks within Yemen. Who knows how that could trigger broader conflict. Yemen supposedly linked to Iran here in this case. Again, 2024 likely going to see a significant increase in global conflict. That means we're going to see war, we're going to see a lot of debt, we're going to see a lot of money printing, we're going to see a lot of money borrowed from the future and spent into the now. You can count on it. Just today, U.S. carries out strike in Baghdad against militia leader. So the U.S. has carried out another strike within Iraq, the Iraqis condemning this strike. And, you know, as long as the conflict between Israel and Hamas persists, I think we're going to continue to see these escalations and both ways. You know, we're going to see more attacks on U.S. military personnel in the Middle East, and we're going to see more retaliation until perhaps we see a miscalculation and a larger conflict erupt. And I mean, I think that this could be the plan after all. Now, let's get back into the economy because, again, you know, I don't think it is any coincidence that we're seeing ourselves being driven closer to a global conflict, to a Middle East regional conflict, as the U.S. economy continues to be plagued by insolvent banks and by a debt-addicted system, which has had the screws turned to it in the form of Fed rate hikes. Look at this story from Bloomberg. Fed's balance sheet leaps into spotlight after repo volatility. Now, remember, in 2019, now that was pre-pandemic, so before any of that stuff happened, it was actually disruptions to these overnight Fed lending facilities, spiking rates there, which forced the Fed to end and reverse that program of rate cuts that they were undergoing at that time. So, there is a historical precedent for this leading to more Fed printing. Traders are back to scrutinizing funds in the Fed's so-called Overnight Reverse Repurchase Agreement Facility, or RRP, where eligible counterparties can park excess cash. Those users have been pulling money from the facility to capitalize on higher yields elsewhere, but as that facility drains towards zero, volatility in the repo market is expected to heat up anew. Now, we're going to come back to this story, but I want to look at another one real quick. This is from Reuters from December 29th. U.S. overnight rate hit record high amid year-end volatility. So this was the, so far, the secured overnight financing rate, the replacement to the LIBOR rate that you might remember from years ago, spiked to a record all-time high over the holidays on Thursday. Now, you might interpret this as a sign of a breaking financing system, of a liquidity crisis. Some were saying that this was a result of just the holidays. There wasn't enough participants in the market to provide the collateral, the short-term U.S. treasuries that were needed for these overnight borrowing. Interpret it as you will. Perhaps it was just a holiday aberration, but I have a strong suspicion that that may not be the case. Back to this article from Bloomberg. Gyrations in benchmarks such as the SOFR, which spiked to a record last week, are set to become more common and severe. In the short term, rates on overnight repurchase agreements, loans collateralized by government debt, are set to normalize this week once Treasury auctions settle and term funding positions for year-end mature. Now, so far, the SOFR has come back down from 5.4% to 5.38%, but this is Royston ICAP economist Lou Crandall who wrote this in a note to clients. If the Fed continues to shrink its balance sheet until the RRP facility is emptied out completely, we think SOFR's day-to-day pattern is likely to resemble the pre-2020 experience rather than the more stable behavior of recent quarters. And again, remember in 2019 that it was a spiking overnight lending rate which caused the Fed to reverse policy and to begin to print, once again, slashing rates. That's why Crandall has said that the Fed will have to stop its balance sheet runoff before the reverse repo facility is entirely drained. In that scenario, any surplus cash sitting in the facility can be redeployed into the repo market in the event there's a spike in funding markets. As noted in the past, this is again a quote from Crandall, we think there is a strong argument for stopping QT this spring or summer, while the everyday level of RRP usage remains structurally positive. And so you can kind of see where things are shaping up here. In 2024, we're going to be heading to conflict. We're going to be borrowing a lot of money if that occurs. And it looks like the Fed may be ending quantitative tightening just in time to come into the market and buy up all of that new war debt. That is how I see things playing out here. Of course, this is the Fed balance sheet. We have, going back to the great financial crisis, you can see 2008, it was under $1 trillion. They bought a lot of debt then, bought a lot more. Back in 2019, again, look, you can see the Fed balance sheet was being drawn down until those rates began to spike up. And this was all pre-pandemic. We saw the Fed having to get back in here and buy up U.S. debt until, of course, we had the pandemic where they bought up, trillions and trillions of dollars for a long time, normalized a little bit, started their QT, had to buy a bunch in March of 2023 when the banks started to fail. Now it's coming back down. But the cracks are starting to show with these overnight rates spiking. The reverse repo facility, it's been drawn down by over $1 trillion since the Fed began hiking rates by March of this year, which is when the markets are anticipating the Fed is going to begin printing again. I think that this number is going to start going up. And, it's very interesting to look. I mean, this is their normalization from here to here, this tiny little drop. Imagine how badly things would break if the Fed were to try to normalize to actually pre-pandemic levels. I mean, yeah, they've sold like $1 trillion worth of treasuries, but they're still at $7.7 trillion. To get back to pre-pandemic levels, they would need to sell over $3 trillion worth of treasuries. It would collapse the whole system. And pretty soon, not only are they going to have to stop selling, they're going to have to start buying again in a very big way. And you can see that just from looking at the BTFP, the Bank Term Funding Program, the emergency lending facility that the Fed established back in March. This is basically E by another name. It's the Fed taking all of these low-yielding, devalued U.S. Treasuries off of the banks' balance sheets, giving them loans at par, way more than the bonds are worth. And now the Fed is sitting on these devalued bonds, and they're going to have to buy a lot more. You can see also that beginning at the end of November, the utilization of this facility, which is set, again, to expire in March, by the way, has begun increasing significantly up to a record high of $135 billion. So when this expires in March, do you think the Fed is just going to give all of these treasuries back to the banks and the banks are going to pay off all those loans? I mean, you have to be dreaming to think that that is going to be the case. Also, we're already seeing signs of what is to come later this year. This is a chart of the M2 money supply. Now, I'm going to zoom this in. This is going back to 2010. I'm going to zoom this into kind of more recent activity here. And you can see that when the Fed began hiking rates and began quantitative tightening, it actually began shrinking the money supply. And it was the first time since the Great Depression that the M2 money supply has declined by this magnitude. But look at what has happened since the end of October. The M2 money supply has actually begun increasing once again. This is as the markets are anticipating a Fed pivot, as the yields on U.S. Treasuries have been coming down as a result of that. Look, the Fed is going to have to begin printing again, or we are going to see an economic event, the magnitude of which will be comparable to the Great Depression, I believe. And look, we may already be headed towards that. In fact, I mean, we're already in the midst of a major economic slowdown, a major economic recession. But at the end of the day, the Fed is going to have to make a choice here, either to begin expanding the money supply again, inflation be damned. I mean, they're just going to have to let inflation run out of control, I believe. And they're going to have to begin expanding the money supply again, something which it looks like they may already have begun doing. The latest data here from December 4th, I have to keep an eye on this for updates. But look, the M2 money supply already expanding once again. I've got Spirit of Strength in the chat here. I'm going to go to the chat real quick. If you guys have any questions or anything you want me to comment on, go ahead and put it in there. We do have a few more stories to cover. I see some people saying hello. Hello, Happy New Year to everybody. Again, please smash that like button. Let's get the likes up. Let's get this information out into the algorithm. I got Spirit of Strength saying, should I hold my silver or trade it for gold? Well, the gold to silver ratio, I haven't looked at the numbers today, but it's somewhere north of 85, I believe. I mean, I'm still stacking silver. That is my focus right now. Nothing wrong with gold. Gold is near record all-time highs. I think it's going to be going a lot higher in 2024. None of this financial advice, by the way. You know, I'm just telling you what I'm doing. But I would be looking to switch some of that silver into gold, perhaps when the ratio drops down to around 40 or lower in the next step of this bull market, which I believe is just getting started in the precious metals, and I think is really going to take off in 2024 as a result of all of the Fed money printing. I mean, as the Fed begins to print and people realize that the inflation battle was never won and that it was never really a sincere battle against inflation in the first place, I think the precious metals are going to look increasingly attractive as a safe haven. Getting back to geopolitics here, just to give you an idea of where we're headed in 2024 and how the year is starting off, you've got Xi Jinping, a big fan of Saudi Arabia's joining BRICS, by the way, and the biggest proponent of abandoning the petrodollar system. He has issued an ominous New Year's speech in which he says China and Taiwan will surely be reunified, so some bellicose statements there. No surprise, North Korea issuing similar, in fact, a lot more bellicose statements. North Korea's Kim says military should thoroughly annihilate the U.S. and South Korea if provoked. Now, look, bellicose rhetoric is nothing new from North Korea. That's kind of their specialty. But 2024, they've got nuclear weapons. They've got ostensibly ballistic missiles. You got to keep an eye out for what they're doing, too. The whole world, you've got Venezuela annexing parts of Guyana, its neighbor. You've got Kim over in North Korea issuing these ominous warnings backed by nuclear weapons. You have China telling us that they're going to reunify, and you have the Middle East just every day an absolute powder keg. I mean, I haven't even looked at the news for the past couple hours. There's probably something new going on there. But look, the one thing that is guaranteed with all of this uncertainty is, I believe, more money printing by the Federal Reserve and a constant and inexorable expansion of the U.S. national debt. Another ominous sign to start off 2024. We just hit $34 trillion in the national debt. We didn't manage to pull it off in 2023. We were just shy, but now 2024 is here, and so is $34 trillion in debt. Expect this number to go much higher. No sign of slowing down. In fact, with the war, which is likely right around the corner, don't forget Ukraine. That's still going strong too. Some very significant strikes on both sides. A lot of munitions being expended by both sides in that conflict, and I'm sure that we're going to have attempts to try to rearm them as well. This number is going to go a lot higher. It's going to go dramatically higher. The debt is going to expand. The debt has to expand, or the debt-addicted financial system, which we have, is going to implode. And, the petrodollar, Saudi Arabia joining the BRICS, that is just another indication that the dollar is going to lose more clout internationally. That means all of this debt, traditionally we've been able to count on petrodollar nations to sell their oil in U.S. dollars. And then what do they buy? They buy U.S. debt. Well, that looks like that might not be the case anymore with Saudi Arabia joining BRICS. At least I think we could see an end to that whole system in 2024. And that means someone else is going to have to buy all this debt. Who's going to buy it? Well, the Federal Reserve is going to be the culprit if you ask me. They are going to fire up the printing presses, return to QE, buy up trillions in debt, and devalue the currency. Because one thing when you see $34 trillion in debt, not to mention $34 trillion in debt, but this number right down here, $211 trillion in unfunded liabilities, the only way to pay for this largesse is through the printing press and through devaluing the currency. So what am I doing? Well, we got silver down around $23 an ounce, I think. I think it's a great time to stack. I just ordered some more Freedom rounds from SD Bullion. I'll do a unboxing when those show up, but look, I think getting into hard assets, getting into commodities, probably the way to play this. Just my take, not for everybody. Let me know what you think in the comments down below. And thanks for watching, everybody. Stay safe and happy stacking. Happy 2024, everybody. I will catch you next time.